On June 2nd, a major indexing shift is occurring as passive rules react to massive private market valuations, with SpaceX targeting a public debut as early as June 12th at a targeted valuation of $1.8 trillion. The NASDAQ has introduced a new 15-day fast entry rule. This changes the game entirely, allowing giant new entrants to join major indexes almost immediately, rather than waiting for months. The mechanics here are a big departure from standard indexing. Typically, a newly public company has to go through a long seasoning period before it can even be considered for index inclusion. Under the new NASDAQ 100 rules, if a new stock ranks in the top 40 constituents by market cap, it gets fast-tracked into the index in just 15 trading days. It bypasses the usual seasoning and liquidity constraints. This policy shift creates immediate buying pressure on passive funds and retirement accounts. Because index tracking funds are required to mirror index weightings, they will be forced to buy SpaceX shares shortly after the IPO. For retail investors holding standard passive index funds, this means automatic, forced exposure to this new mega cap, regardless of private to public transition pricing. Meanwhile, legacy financial exchanges are experiencing a silent valuation re-rating. Traditional derivatives giants like CME and CBOE have seen their stock prices face a sharp sell-off, with CBOE down 17% in a couple of days. The pressure is coming from decentralized competitors, like Hyperliquid, whose perpetual swap contracts are capturing high-margin hedging and arbitrage volume away from legacy platforms. To defend their territory, traditional exchanges are pushing for continuous trading. CBOE just received SEC approval to launch 23-hour, 5-day stock trading by the end of the year. While the goal is to capture global 24-hour retail flows, it comes with a major catch. Operating costs for market makers and exchanges are expected to spike, which is why institutional capital has reacted by selling off exchange shares. Over in the technology sector, the focus is expanding beyond GPUs to the infrastructure that connects them. At Computex 2026, NVIDIA CEO Jensen Huang publicly praised Marvell Technology, calling it the next trillion-dollar company. This endorsement highlights Marvell's role in the AI hardware supply chain and triggered a surge of over 25% in Marvell stock. The technical catalyst for this endorsement is bandwidth. As AI models scale across tens of thousands of GPUs, the speed of chip-to-chip communication becomes the primary bottleneck. Marvell's custom chips and 1.6 terabit optical digital signal processors are critical components in NVIDIA's NVLink Fusion platform, turning a hardware partnership into a high-barrier infrastructure moat. To fund this massive infrastructure expansion, tech giants are raising capital at an unprecedented scale. Alphabet has announced a massive $80 billion equity capital raise plan. The goal is to fund their aggressive AI infrastructure build-out, as Alphabet targets a 2026 capital expenditure budget between $180 billion and $190 billion. A key part of Alphabet's capital raise is a $10 billion private placement from Berkshire Hathaway, split evenly between Class A and Class C shares. This transaction increases Berkshire's holding in Alphabet by 49%, bringing their total position to 86.4 million shares. It represents a major endorsement of Alphabet's infrastructure scale by Berkshire's leadership under Greg Abel. At the same time, Greg Abel is charting a distinct path for Berkshire's traditional portfolio. Berkshire has agreed to acquire homebuilder Taylor Morrison in an all-cash transaction valued at $8.5 billion, representing a 24% premium. The announcement caused Taylor Morrison stock to surge 22%, marking Berkshire's first major multi-billion-dollar deal under Abel's executive leadership. This dual-track strategy reveals a fascinating allocation contrast. While Berkshire is backing Alphabet's AI build-out with $10 billion, Abel is also deploying $8.5 billion into home building, an undervalued sector facing high interest rates and cyclically depressed valuations. It shows Berkshire is balancing its high-momentum tech exposure with tangible, cash-flowing assets in the real economy. Looking globally, a different kind of safety play is unfolding in Europe. Despite hawkish signals from the European Central Bank, European banks purchased a record 23.7 billion euros of government bonds in April, bringing their year-to-date buying to over 175 billion euros. This indicates that banks are prioritizing highly liquid government debt over lending to the real economy. This flight to safety is happening just as private credit markets are showing early signs of stress. European non-bank financial institutions drew down 22.3 billion euros from bank credit lines in April, signaling a developing liquidity squeeze in the shadow banking sector. As banks tighten lending standards, these credit line draws show where the real economy funding bottlenecks are forming.